Hi, I'm Megan Shigo, and I've been a licensed realtor since 1998. I've sold over 1,000 homes, and I'm here today to help you have your best buying or selling experience.
Hi, Joe. Good morning.
Good morning. How are you, Megan?
I am doing well. I'm so glad that you were able to carve out some time to talk to me a little bit this morning. And I'm going to let you sort of introduce yourself and tell us a little bit about you and what you do, and then we'll kind of go right into the subject.
Well, my name is Joe Wilson, and I'm an attorney, and I specialize in tax. I've been working in the tax field for approximately almost 19 years now. And I practice my practice is located in Orange County. I have two offices, one in Newport Beach and one in Yorba Linda. And essentially what we do is we help clients and businesses resolve tax matters. And my background, prior to going to private practice, I worked for the government, former IRS attorney. And and I also worked for the U.S. Attorney's Office as in the tax division, representing the United States in tax litigation in court. And I also worked for the Franchise Tax Board for the state. So I've taken that experience, and now I'm in private practice. And what I do with it is, I help clients and businesses, resolve tax matters.
I love that. You have so much experience with so many different hats on that it really probably enables you to see things from a lot of different perspectives.
Yeah, it definitely helps having the government experience, understanding how the big machine works and all the different parts that are involved. And, I now use those tools to, benefit our clients.
I love it. Well, good. Well, I know that you're a busy guy, so we're going to move right into the questions here. Now, Joe, in the last year and a half, I've been in real estate, I told you about 23 years, but in the last year and a half, I have seen a lot of money, a lot of people cashing out, moving to other states. And, I'm not allowed to give tax or legal advice because that's not what I'm licensed to do. And so I refer them to a tax professional, but I wanted to talk about just three sort of topics here. And maybe you can just give me a little intel. And if they want more information, they can contact you. Okay.
Sure.
So people seem to think that, let's say it's a married couple and they're selling a house in Yorba Linda, and let's say their tax liability, they're going to walk away with about $750,000, right? Now we know that they have a $500,000 exemption because they're a married couple, but then there's another 250 on there. And they seem to think if they take all that money and take it to Idaho and buy a commune for their whole family, that they won't have to pay any taxes on that liability. What says you?
Well, I think it's important for anyone who's selling a house to maybe have a conversation with their CPA or tax professional before they're selling their house to kind of have this discussion, because yeah, there are tax consequences involved with selling a house. And there are two types of sales. You have a sale where it's like a rental or investment type property, and then you have a type of sale where it involves your principal residence. So depending on what type of property is going to determine how the tax consequences work. So if for in your example, if it's a principal residence of a married couple and they're selling their home, yes, there's a $500,000 exemption, and both there's a federal exemption, and California conforms to it as well. But that doesn't necessarily mean the whole the difference is going to be tax-free. So it really depends on their basis in the property, what they bought it for, and what records they have to support any improvements and things like that. And that will really, help determine what the tax consequences will be. And so I recommend that clients, before they sell their house, they let their CPA know, or their tax preparer, or if they have a tax attorney involved, they talk to them and kind of get an idea. Because if there are tax consequences and they don't pay the taxes, then, you know, they're going to owe penalties and interest, and they're going to owe more than, they would have owed if they had just done a little bit of planning.
Right. I agree. And it's like our whole attitude about things in life is so much different when we know things ahead of time. Then, if you're totally aware of it and you can make peace with it and you can plan for it, it's so much different than getting one of those ugly letters in the mail and having to call a tax attorney. It's just a mess,
Yeah, absolutely. It's always better to plan ahead rather than then have to clean up the mess later.
Yeah.
Absolutely.
And you mentioned keeping records, which is really important. What kind of records, just off the top of your head, would be a good items for people to keep record of?
Well, the record keeping is really important, because even if you made improvements and things like that, but if you don't have records to support it, the IRS or the state's not going to allow you to claim, those improvements to reduce your gain from the sale of the property. So keeping records is important, both the type of records and how long to keep them. So I think there's two parts to that question. I'll address first. I want to address, how long you should keep them. A lot of times you'll hear different opinions on how long to keep your tax records. Some people say 3 years because that's the amount of time you can get audited. Some people say 6 years. But when it comes to sale of a property, the time you should keep your records is the entire amount of time you've owned that property. So if you've lived in that property for 30 years, well, you're going to, for purposes of when you sell your house, whether or not you're going to maybe owe any taxes from capital gain taxes, you want to keep the records, the life of that property. So it could, however long you own it, 5 years, 10 years, 30 years, you keep the records for that long for purposes of what improvements you do on the property. So the type of records you want to keep are the records involving improvements. Two types of things: there's improvements and repairs. It can be confusing, but improvements are things like additions that you do to the house. If you add a room, remodels, if you're going to redo the kitchen, you're going to redo the living room. Repairs are things like painting the house, redoing the carpet. Those are the type of records you don't necessarily need to keep as long, but any type of improvement. So like I said, remodeling, adding additions, things like that, you want to keep all those records. And the type of records would include, the bank statements, checks that you use to pay the contractors, invoices from your contractor, things like that. You want to keep those records for the life of the property.
That's a very good point. And yeah, that's and it's good too for us realtors when someone has those records, because when we have an appraisal done, the appraiser wants to know what kind of improvements you've made. So keeping records is definitely going to benefit you in all situations in selling your house.
Absolutely. And photographs too, like the before and afters. Photographs are really, really helpful as well. So if you have pictures of what it looked like before and then pictures afterwards, that also helps quite a bit.
I love that. And, I think too, another consideration is sometimes people, they buy a house, they live in it, they make a lot of improvements, and then they sell it prior to their 2 years of owning it. And I mean, there's a special kind of tax that's due then, right? It's a short-term capital gain.
Well, if you hold the property for less than a year, you're going to be paying basically regular tax rates. That really depends on how much money you made that year. So you can be, it's not a capital gains tax rate. If you hold the property for more than 2 years, you're going to be paying, then you get capital gains tax rates, which are lower. But I think that's if you hold the property for more than 1 year. If you want to qualify for the exemption, which is the principal residence exemption, That's where if you live in the house for at least 2 out of the last 5 years, qualify for that $500,000 exemption. If you're married, $250,000 if you're single. That's where that holding period comes into play.
Well, good. Well, you've given us a lot to think about today, and I'm going to spread the word because we really want everyone to have their best experience, you know, when they're buying or selling property. So I think that definitely being able to protect, you know, your assets and be smart about it, and call your tax professional ahead of time, and keeping records, that these are all really great pieces of advice. And I really appreciate your time today, Joe.
You're welcome anytime, and I'm happy to help out. If you have anybody that needs assistance, we're here for them.
I love that. And I'm going to post Joe's info here so you can contact him directly if you need assistance. He'll be happy to help. Thanks, Joe. Have a great week.
You too. You take care now.
Thank you.